Good day and welcome to Markets Today. I'm your host, Mbithe Mwema. It's a Friday. It's very exciting for us here at Markets Today. You know why? Because it's all about Ask Mbithe, a space where you get to ask me anything to do with investments in Kenya and also in other countries, just to help you learn and understand what are the key things that you need to be considering in as far as you're making investments in Kenya. Today in our show, I'll be giving you an overview of what has been happening on the Securities Exchange this week, as well as the key corporate news that have come through overnight. Let's start off. This week, there has been a consistent conversation coming through from the Retirement Benefits Authority with proposals from Treasury to be able to defer interest rate payments. What is happening with the government operations? We had a very interesting conversation yesterday with Mr. Kwame Owino. He is an economist as well as the CEO of the Institute of Economic Affairs. I hope you can be able to watch it on our YouTube page and just to get a recap of what we discussed. From that, I was able to get the fact that we are actually operating on a very massive deficit as an economy. The last reported revenues for the government of Kenya, 1.1 trillion in March, working against a budget deficit of 3.2 trillion. COVID has happened, meaning that it's going to get worse for the upcoming fiscal year, which starts in July. What I'm saying is the government is in a space where, because of COVID, it's becoming harder for it to make good its obligations, whether it's in terms of revenues or, more importantly, debt obligations. Debt obligations typically are about 600 to 700 billion, but if you include interest and any outstanding payments, this could stretch to about 1 trillion shillings. That's the amount that the government needs to make. This is a government that only raises about 1.1 trillion in revenue, or maybe 1.2 or 1.3 trillion in this year. Will it pay for its wages, or will it pay its debt obligations for the year? I think this is some of the concerns that are coming through in as far as the fiscal deficit and the credit worthiness of the government of Kenya. These are not concerns that I only have or other economists have, but it's a concern that Moodys, a global rating service agency, has as well. Yesterday, it lowered the outlook for Kenya from a B2 stable to a B2 negative. Its key concerns are debt obligations, and for the government meeting its debt obligations for domestic bonds as well as for global bonds. You really don't want to be getting a negative outlook because it makes it harder for you to be able to go to global markets to raise funding. Over and above that, the same global markets are becoming harder to access because COVID has affected everybody, and it's a bit hard for you to turn to Big Brother when Big Brother's house is also burning. In all of this, some of the risk factors we have seen, depending on whether this proposal sees the lights of day, include the fact that there could be an erosion of confidence in as far as investing with the government of Kenya is concerned. In Kenya today, you're limited in terms of the alternatives that you have for investments. Typically, you will invest either in your own business, you'll invest in the Nairobi Securities Exchange, that's in stocks, or you will invest in money markets or directly through the government of Kenya T-bills or T-bonds. These T-bills and T-bonds have not traditionally been a very safe haven for people who are looking for a good return and no hassle. If the government is considering deferring interest payments, even though it's for a short term, then it really causes an upheaval in as far as pension assets are concerned, and investment in this class that has been considered safe for over a very long time is concerned at this point in time. We are in a space where the government cannot pay money, but we wait to see whether the proposal to defer interest payments sees the light of day. The fact that Moodys has actually picked it up and brought it to light could mean that this proposal doesn't see the light of day. Whatever happens, you do know that Markets Today is a space to be if you want to understand what's happening. In corporate news, Bumbury Cement has announced its full year numbers for the year ended December 2019. The profit after tax was down 62% to 359 million shillings. The interesting thing is Bumbury's revenues were more or less flat. They did grow 1.1% over the year. However, the company did say that because of having to pay an additional tax charge for the year just ended, they were not able to report good numbers for the year. Did they declare a dividend? Well, no, they did not declare a dividend. So this year it's zero dividend. And for those of you who've been buying the stock assuming that the dividend yield would continue, you're certainly now getting to the point where there's actually not too much in terms of an investment case for Bumbury today, unless they get to the point where they're able to increase their revenues and be able to return to profitability and pay shareholders dividends. The concept of the dividends here is very important for those of you who have been looking for dividend yielding stocks on the Nairobi Securities Exchange. I bring it up as a point of caution, largely because when COVID has happened and affecting the finances from these companies, there will be a negative impact on these companies that have been paying out dividends. I can't keep on paying dividends as a company if I cannot even meet my daily obligations. So be careful if you've been buying stocks because of a dividend yield, and maybe pay more attention and ask yourself basic questions of, will this company make money? Will it be able to pay me? If not, hold on to your cash. And if nothing else, what we've had this entire week, and something that I've constantly been saying, cash is king. Hold on to your cash, have it with you, and when the time comes and the opportunities come your way, be sure to pick them up. We take a break, but when we come back, we will be joined by Conchita Lillian. I like to call her my sister from another mother. Conchita is a digital strategist as well as the host of The Social Diary, which is a weekly show that airs on Metropole TV at 7:30 p.m. She collates information in terms of events, and she's always out there just trying to give us a sense of what is happening. Today, we will be taking a discussion with her just to understand what can I do to help her understand stocks. What is it that she would like to know from me? I'm so sure it'll be a very exciting and engaging conversation, and I also hope that you can join me from the comfort of your home. Our SMS number is 20146. You know, my Twitter handle is @BithemWema or Metropole TV. We would like to hear your questions. Tell us where you're watching us from, and we will endeavor to answer all your questions. Thank you once again. Keep safe. Sanitize, wash hands, put on your masks. But from our investment desk to your investment strategy, cash is king. Hold on to cash. Be very wary and careful of making investments now, because the liquidity crunch that is going to happen will mean that there will be many people who are desperate for money and coming up with fake investment schemes to be able to separate you from your money. Do not be like the proverbial fool who's separated from his money. Instead, be the person who applies wisdom to allocating your funds so that you can be able to grow them in the future. We will see you after the break. Thank you.